Welcome to the deep dive. For years, the entire rallying cry of the crypto faithful, the real core belief, has been about freedom.
It's all about sovereignty, right?
Exactly. You wanted a currency that no government could just seize out of the blue, that no bank could freeze because they didn't like a transaction you made, and, certainly one that no politician could just debase by printing more money.
Right. And people jumped in, many got in very early, and they saw incredible returns. They really believed they had found this new form of financial sovereignty, completely outside the old walls of traditional finance.
They thought they were operating in a different universe. But that's the dangerous reality check that's happening right now. While you were watching the charts go up, watching your portfolio grow, the government, the regulators, their forensic contractors, they were all quietly watching something else.
They were watching the blockchain itself, and they were building tools to understand it.
And that is the central conflict we are investigating today. It's this myth of digital freedom crashing headfirst into the reality of absolute digital accountability.
And it all starts with one incredibly common, and I have to say, incredibly costly assumption.
Yes. The idea that, okay, if I just move my Bitcoin off a centralized exchange, off of Coinbase or Kraken, and I hold it in my cold wallet,
My ledger, my Trezor, whatever hardware I'm using.
then it's invisible. It's safe. They can't touch it. They can't see it.
And that line of thinking isn't just a little outdated. It's financially hazardous at this point. The very architecture that makes crypto trustworthy, that radical transparency, is simultaneously the most effective tool for total surveillance ever created.
That's it right there. The whole game has changed. The government's new strategy, it isn't this old clumsy idea of just banning crypto outright.
Oh, that would never work. It would just drive innovation offshore, and they know that.
Right. Their new strategy is far more elegant and, frankly, infinitely more profitable for them. They don't want to ban it. They just want to become your silent, your enforceable 45% partner in every single profitable move you make.
And the entire system they've built to enforce that partnership, that's what we're calling the crypto tax trap.
So our mission today is a full forensic investigation into this trap. We are going to open the file on the, frankly, frightening deployment of AI surveillance tools like Chainalysis to figure out if anonymity is really and truly dead.
And then we're going to get into the really sharp end of it, the money. We'll debate whether taxing paper profits, unrealized gains, is basically the functional definition of government confiscation.
And we'll analyze the closing of a major loophole, the wash sale rule, which is a massive blow to any active trader out there. We're looking past the headlines, past the FUD, and really analyzing the infrastructure that they are building.
The plumbing of the new system.
Exactly. So let's start where all the paranoia begins, with the central question this whole deep dive is going to answer. Is the public permanent nature of the blockchain, the very thing designed for trust, actually the ultimate surveillance tool ever invented? Okay, so let's unpack this because it's so fundamental. If we're going to understand the surveillance side of things, we have to start with that foundational truth that the early crypto community, frankly, celebrated.
They absolutely did. The fact that the blockchain is a public, permanent, and transparent ledger. That was the whole point.
That was the selling point.
It was a revolutionary idea. You don't need to trust a bank. You don't need to trust a third party. You just need to trust the math and the fact that everything is visible. Every single transaction, all the way back to the Genesis block, is recorded forever. Anyone with an internet connection can see it.
But that's the twist. That indelible public record, which was once a shield for the user, is now. It's a perfect tracking beacon for law enforcement and tax agencies. The data is permanent and it's universally accessible.
And they absolutely have the mandate and the resources to access and analyze that information.
So let's talk about where this really kicks off. The IRS initiative known as Operation Hidden Treasure. I mean, it sounds like something out of a spy movie.
It really does, but it's very real. This isn't just a couple of agents manually reviewing tax returns. This is a dedicated, highly sophisticated deployment of federal resources, and it's aimed squarely at digital assets.
So what is its goal specifically?
Operation Hidden Treasure is all about enforcement at scale. The explicit goal is to use advanced AI and analytical software, most of which is provided by third-party contractors, by the way, to just constantly scan the blockchain.
Looking for what?
Specifically for unreported income. They are hunting for taxpayers who either just failed to declare any of their crypto transactions, or maybe what's more common, people who underreported the gains they made when they sold.
It's like a massive digital eye just opened in the darkness. You thought you were moving around in the shadows of anonymity, but now this. This ridiculously powerful analytical system is projecting a high-res grid over the entire landscape, just identifying targets.
That's a great way to put it.
So the terrifying question for anyone listening is, how? How does that digital eye connect an anonymous string of numbers and letters on a blockchain to your actual name, your social security number, your home address?
And that brings us to the Chainalysis Trap. The paranoia that you hear in the space around the capabilities of this software, it's entirely justified because it all leverages a single, basically inescapable point of failure for, I'd say, 99% of investors.
And that is?
The KYC trigger.
Know your customer. That moment, and for some people this is years ago, when you first wanted to buy crypto and you had to open an account, you went to Coinbase or Kraken or the US version of Binance.
Precisely. The IRS doesn't need to crack your encryption. They don't need to physically get their hands on your hardware wallet. They just use the law. They use information reporting mandates.
They just compel the exchanges to give them the data.
They force those centralized regulated companies to hand over everything. Your real name, your address, your social security number, and, this is the critical piece, a record of all the initial wallet addresses that are associated with your account on their platform. We'll call that Wallet A.
So Wallet A is the known entity. It's permanently on record as belonging to Joe Smith at 123 Main Street. That first act of compliance, years ago, that's the fatal flaw in the whole anonymity chain.
It is the anchor point for everything that follows. From that moment, the Chainalysis software can begin its forensic mapping. And it uses these incredibly complex algorithms. They call them clustering heuristics.
Okay, so what does that actually mean? I'm an investor. I move my funds from Wallet A on Coinbase to Wallet B, which is my supposedly private cold storage ledger. I think I've broken the link.
You think you have, but Chainalysis doesn't see Wallet B as anonymous at all. It sees a definitive, 100% traceable on-chain transaction from a verified KYC account, Wallet A, to this new unverified Wallet B. That creates a permanent, linkable transaction history. It's there forever.
But hold on. What if I'm a bit more sophisticated? I don't just move it all to one wallet. I break it up. I send half a Bitcoin to Wallet C, half a Bitcoin to Wallet D. Surely that starts to muddy the waters, right?
You would think so, but that's where the real sophistication of the AI kicks in. It's not just following one-to-one transfers. It's applying these complex heuristics that were developed specifically for network analysis. One of the big ones is called the common input ownership heuristic.
Common input ownership. Break that down.
Okay, so when you create a new transaction, you often need to pull funds from multiple previous inputs to get the total amount you want to send. Let's say you want to send one full Bitcoin, but you only have half a Bitcoin in Wallet C and half in Wallet D.
Right, I have to combine them.
Exactly. The moment that Wallet C and D both contribute funds to a single subsequent transaction, a single output, the system concludes with an extremely high probability that those two wallets are controlled by the same person.
Wow. So just by spending from two of my secret wallets at the same time, I've basically told the AI that they belong to the same person.
You've linked them. The AI instantly groups them together. It creates what you could call a digital fingerprint. It's a cluster analysis that says, okay, these 15 different addresses all exhibit transactional behavior that is consistent with being under the control of a single entity.
And it just keeps mapping this out.
It maps the entire web. It can trace tiny fractions of coins across dozens of wallets, across different blockchains, spanning continents. The pattern recognition capabilities are just, they're astounding.
This is where it gets, I think, really chilling, and it really speaks to that paranoia. It's the behavioral linkage. It's not just about inputs and outputs anymore. What specific behaviors does the system look for to really nail down the link between that cluster of wallets and my actual KYC identity?
Right, because correlation isn't always causation, but they build a case. The AI is trained to flag behavior that's either suspicious or highly identifiable. For instance, if your whole cluster of wallets, B, E, C, and D, starts interacting heavily with known mixing services, like Tornado Cash was, that's a huge flag.
But does that break the link?
No, quite the opposite. It doesn't break the link. It just makes your cluster a much higher priority for human review and scrutiny. But even more importantly, say Wallet B later interacts with some DeFi protocol, or uses a cross-chain bridge, or it sends funds to a vendor that requires any kind of physical delivery.
Like buying something online that has to be shipped to your house?
Exactly. Or even just the timing. The timing itself is a massive behavioral flag.
What do you mean by timing?
Okay, so let's say Joe Smith logs into his Bank of America account and wires $50,000 to Coinbase at 9 a.m. on a Tuesday. And then at 9:30 a.m., Wallet A on Coinbase sends $50,000 worth of Ethereum to wallet B.
I see. That's not a coincidence.
To the AI, that is a massive red flag. They build a case based on this high probability that far, far surpasses the standard of proof they need to just initiate an investigation. They don't need you to confess, they just need high correlation and clear patterns of movement.
So if the system is this good, if it's this effective at mapping everything out, why is the IRS still sending out what they call soft letters? That's the concrete proof that their tracking works, sure, but it almost sounds like they're not confident enough to just go straight to an audit.
That is a fantastic and critical point. The soft letters, and they have sent out tens of thousands of these things, are absolutely proof that the tracking works, but they're also a pressure tactic. It's a tool of efficiency.
What do you mean?
The letter is basically a warning shot. It says, hey, we know you have an undisclosed crypto footprint. We have traced substantial funds moving from your verified account wallet A to this unverified cluster of wallets. We strongly suspect you haven't reported gains.
And the implied threat is?
Amend your tax return now, before we commit the legal and human resources for a full, formal, and very painful audit. It's an efficiency measure. It forces a huge number of people into voluntary compliance just based on the credible threat of overwhelming evidence.
And that saves them a fortune in legal and auditing costs. They don't have to win thousands of individual court cases.
Precisely. They let the threat of the surveillance do the work for them.
So the key takeaway from this whole forensic file is just, it's definitive. The era of assuming you have anonymity just because you hold your own seed phrase is over, at least for any substantial investor. The technology has completely surpassed the old tax evasion strategies.
They know your keys.
Yeah.
Or, to be more precise, they know who owns the cluster of wallets that controls those keys, and they are using that knowledge to set the stage for the real financial threat.
Right, because the surveillance we just laid out, as scary as it is only the enabler. It's step one. It provides the IRS with the target and the proof they need. The tax trap itself is the financial punchline that follows. And you have to see this in the larger context, right? The macroeconomic picture. Washington is dealing with just staggering levels of national debt, and they are desperately looking for new, massive, and hopefully politically palatable revenue sources.
And you look at the landscape and you see hundreds of billions, maybe even trillions, in appreciated digital assets that have largely gone untaxed. It's an irresistible target for them.
This is where we have to shift from the fear of just being audited to the fear of, well, genuine financial injury through a major policy change. We're talking about the legislative push to tax unrealized gains.
And this is a concept that just shakes the absolute foundation of how capital gains taxes worked in America for a century.
Explain that. What's the traditional system?
The traditional capital gains tax is only triggered upon what's called a realization event. It's simple. You're only taxed when you actually sell the asset for cash, when you realize the gain.
But this new proposal, which is really driven by this broader desire for wealth taxes, it wants to implement an annual mark-to-market system, at least for high net worth portfolios.
A mark-to-market system. So it would calculate the year-over-year growth of your entire portfolio and then tax that growth, even if you never sold a single share, a single coin, a single asset.
Okay, let's run through the specific mechanism example from the source material, because I think hearing the numbers makes the gravity of this proposal really hit home.
Let's do it. So imagine a successful early crypto investor. Let's say they bought one Bitcoin years and years ago at $20,000. Now it has appreciated significantly. At the end of the tax year, it's sitting at $100,000.
Okay, so that's an $80,000 gain, but it's all on paper.
Exactly. The investor is a Hosho dealer. They're still holding that coin in their cold wallet. They have realized exactly $0 in cash from that investment. It's all just paper profits sitting in the digital ether.
And under this proposed mark-to-market system, the IRS just, they don't care that it's on paper. They look at that $80,000 gain, they figure out what your tax rate is, and they send you a bill that's due right now.
That's right. And assuming you're in a high-tax state like California or New York, that bill could easily be $30,000, maybe even $40,000.
And this immediately brings up the existential question for you as the investor. Where on earth do you get $40,000 in cash to pay a tax bill on a completely non-liquid asset?
You don't have it. Nobody has tens of thousands of dollars just sitting in a checking account waiting for a tax bill on imaginary money.
Which means you are legally compelled to sell a portion of your appreciating asset, your Bitcoin in this case, just to generate the cash you need to pay the government's tax demand.
And this is exactly why opponents label it a forced liquidation event. The government is literally mandating the sale of your appreciating asset, not because you wanted to sell, but purely to service their tax requirement on a gain you haven't even taken.
And that gets to the heart of the debate, right? Is this confiscation? I mean, opponents would argue that this mechanism it fundamentally undermines the entire principle of property ownership and realized income. It actively forces you to dismantle your own investment strategy.
Yes, before you, the investor, ever decide you want to cash out or turn that wealth into something you can consume.
Now, you've painted a picture of, pure confiscation, but
Yes.
let me play devil's advocate here for a second and introduce some critical friction.
Please.
If you have high net worth investors sitting on hundreds of millions, maybe billions, in untaxed, highly appreciated assets, isn't there a genuine argument from an equity perspective? Especially with the national debt where it is. Hasn't this kind of thing been tried before?
That is the central counter-argument that proponents of a wealth tax will always use. And it's not without merit on its face. They argue that the current system allows the extremely wealthy to indefinitely defer their tax obligations, sometimes for generations, while your regular wage income is taxed immediately and automatically.
They frame it as a fairness issue.
Exactly. A necessary equity measure to make sure that vast wealth accumulation actually contributes to the societal funding structure. And yes, historically, similar proposals have been floated. Some jurisdictions have taxes on asset appreciation upon transfer at death, for example. But a full annual mark-to-market system on illiquid volatile assets like this, that's highly, highly contentious in the U.S.
It really feels like the mechanism itself is what creates the deep instability. And when you look at the tax rates we're talking about, especially for anyone who is considered a short-term holder or is in the highest income brackets, the combined rates just get to a place that's, well, it's hard to defend.
We are talking about ordinary income rates here. If you've held the asset for less than a year, you're looking at the top federal rate of 37%. Then you add the 3.8% net investment income tax, surtax, which hits high earners, and then you have to pile on state and local taxes.
So in some places, you're easily approaching 45%, maybe even higher.
And that rate, that almost 50% rate, is being applied to money that is not only not yet liquid, but is also wildly volatile.
45%. Let that sink in. On your $100,000 gain, the government wants $45,000 of it in cash. Now, this introduces a just tremendous volatility risk for you, the taxpayer, that just doesn't exist in the traditional system.
It creates a massive timing mismatch. This is the key. Let's extend that example a bit. Say you get that bill and you pay your 45% tax in March based on the Bitcoin being worth $100,000 at the end of last year.
Okay.
What happens if, by June, the crypto market has a huge correction and your asset drops back down to $50,000?
Oh, wow.
You have already paid tax on value that literally evaporated. It's gone. And here's the most crucial part. The government never, ever offers you a refund for unrealized losses. You've paid the tax, and now your remaining capital is trapped in an asset that's worth far less than you thought.
So the system is perfectly engineered for the government to be a full partner in any upside, while you, the investor, are left holding all of the risk of the downside.
It's like that image of a robotic claw just ripping the golden apple, the appreciated value, right off the branch before the gardener has any chance to even see if the apple is real or if it's going to rot on the ground.
And this is not some, far-off theoretical threat. The proposals are serious. And the development of these forensic tracking capabilities, the Chainalysis, the Operation Hidden Treasure, that's what makes this tax enforceable now.
That's the key connection. They had to solve the tracing problem before they could credibly propose this kind of tax. Now they believe they have.
So the surveillance sets up the target, and this proposal to tax unrealized gains is designed to extract that target's value immediately, and in a way that often results in a forced exit from your own investment. Okay, so now we have to pivot from that high-level sort of existential threat of a wealth tax to a very specific mechanical nightmare for active traders, and that's the closing of the wash sale loophole.
This is huge. For years, this exemption has given sophisticated crypto traders a tremendous advantage. I mean, the source material calls it a genuine superpower, and that's not an exaggeration. It's something traditional stock traders could only dream of.
And its closing is just another signal of the maturing regulatory environment. It's a sign that the Wild West days are coming to a very abrupt end.
I would say this change is absolutely devastating, especially for anyone running automated trading strategies or really anyone who uses volatility as a tool for tax optimization.
Okay, before we get into what the loophole was, let's just define the existing rule that governs traditional markets. What is the wash sale rule?
The wash sale rule is Section 1091 of the Internal Revenue Code. It's an old rule, and it was designed specifically to prevent what they call tax loss harvesting abuse.
So what does it say?
The rule states that if you sell a security, a stock, a bond at a loss, you are prohibited from claiming that loss as a tax deduction if you buy back the same security or one that is substantially identical within a 61-day window. That's 30 days before the sale or 30 days after the sale.
And the intent there is pretty obvious, right? They don't want you deducting a loss if you never really got out of your position. You can't just sell your Apple stock on December 31st to book a $10,000 loss for your taxes and then immediately buy it all back on January 1st.
Exactly. You can't claim the loss while maintaining continuous uninterrupted ownership of the underlying asset. But here was the crucial glitch for crypto.
This is the key.
Historically, for tax purposes, the IRS classified Bitcoin and other digital assets as property, not as securities or commodities. This was a really important distinction. They were treated more like gold or art or real estate.
And because the wash sale rule historically only applied to securities,
Crypto was exempt. And that exemption created what some people called a tax-free money glitch that active traders could exploit constantly. It really was a superpower.
okay, so walk me through how powerful this was. Give me a real-world example of how a trader would use this.
Okay, so think about the insane volatility we've been talking about. Let's say Bitcoin has a sharp drop one afternoon. It could be a flash crash, even just a dip that lasts for a few hours. A trader could execute a very specific strategy.
What's the move?
They would immediately sell all their Bitcoin at that temporarily realized loss. Let's say they lock in a $50,000 capital loss. That credit can now be used to offset $50,000 of capital gains they made earlier in the year on other trades.
Okay, so they've harvested the loss for tax purposes.
Right, but here's the superpower part. Because the wash sale rule didn't apply, they could then buy the exact same amount of Bitcoin back 5 minutes later at roughly the same low price.
So they never really gave up their market position. They didn't miss the rebound that came an hour later. They had no real market exposure shift, but they walked away with a massive tax deduction.
Precisely. They essentially created a huge tax benefit for themselves without incurring any real economic downside risk, other than, tiny transaction fees. This allowed algorithmic traders to just dynamically manage their tax bills all year long.
This sounds like a structural advantage that anyone in traditional finance would. I mean, they'd kill for that kind of flexibility. How big of an impact did this really have on the profitability of high-frequency crypto trading?
It was completely transformative. In a market this volatile, this single technique could be the difference between a profitable but heavily taxed year and a highly profitable, minimally taxed year. It was a core fundamental component of any serious tax optimization strategy, especially for U.S.-based hedge funds and pro traders.
But now it's over. We're seeing explicit plans in new budget proposals to apply the wash sale rule to digital assets. This isn't just a rumor anymore.
No, it's a legislative mandate closing in fast. The plan is to change the definition of the classification within the tax code to make sure that digital assets are treated just like stocks and bonds for the purpose of loss harvesting. The effect is the immediate and total elimination of that superpower.
The 30-day clock will apply to everything.
To every single digital asset sale.
So what's the immediate dramatic impact this has on an active trader's bottom line?
It fundamentally reshapes the entire profitability model of short-term trading. It's a body blow. If you can't offset your winners with these temporary minor losses anymore because you have to wait 30 days, you are just left holding the full, unmitigated tax bill on all your successful trades.
And if the market dips, you now have a terrible choice to make.
Two very unpalatable choices. One, you can sell at a loss and take the deduction, but then you have to sit on the sidelines in cash for 30 days, and you could potentially miss a massive rebound in this market. Or two, you can HODL through the dip, but then you forego the tax deduction entirely, and you're still on the hook for the full tax liability from your earlier gains.
So you take the full tax hit on your winners, and you completely lose the flexibility to strategically use your temporary losers to minimize that hit. The net result is that active trading just became far, far less profitable on an after-tax basis.
It's the final tightening of the net. It signals the end of that unregulated landscape where these massive tax benefits were just... They're structural and easy to get.
Yeah.
The image you used before is perfect. That massive steel door labeled wash sale rule is just slamming shut.
And it's crushing the single greatest structural tax advantage the crypto space ever had.
It forces everyone to treat crypto just like any other highly regulated security, which means higher effective tax rates and way less flexibility.
So let's just summarize our forensic investigation up to this point, because it's a pretty bleak picture. You can't hide from the blockchain. The Chainalysis tools are just too good now.
And you can't assume your paper profits are safe. The government is aggressively moving to tax them, whether you've sold or not.
And you definitely can't rely on the old loopholes to save you. The wash sale exemption is all but dead.
Which means the entire strategy for successful long-term crypto investment has to shift.
Yeah.
It must shift. The old era of just, I'll hold it in a cold wallet and that's my primary defense mechanism, that's over.
So the strategy has to move from this failed attempt at anonymity and evasion to what?
To sophisticated legal compliance and optimization.
Right. So what does the smart money do now? What are the high net worth investors, the ones who are actually facing a potential 45% tax bill on their gains? What are they doing to protect their wealth?
They're pivoting. They're moving from evasion, which is now forensically impossible, to legal optimization. This is what we call the smart money playbook. And these strategies are complex. They leverage very specific, sometimes niche sections of the tax code to dramatically reduce or even completely eliminate their tax liability.
Okay, let's start with the first one, the CRUT. That's CRUT, the Charitable Remainder Unit Trust. This thing is often called financial genius because of how it handles assets with huge appreciation.
It is absolutely brilliant because it solves that immediate and massive capital gains problem we've been talking about. So take our investor from before. They bought Bitcoin for, say, $1,000, and now it's worth $1 million.
A huge unrealized gain.
A huge unrealized gain. They move that highly appreciated crypto into the CRUT. Now, critically, that transfer itself is a non-taxable event. And because the trust is charitable, the investor gets a significant immediate income tax deduction just for funding it.
So wait, I get a tax deduction just for moving the asset into the trust, but the massive capital gains bomb is still sitting there inside the trust, right? It's just waiting to go off.
And here is the genius step. The trust then immediately sells the crypto for its fair market value, $1 million in our example. Because the trust is legally a tax-exempt charitable entity, it sells the asset completely tax-free.
Zero capital gains tax on the sale.
Zero. That 45% tax hit that would have been $450,000,
Yeah.
it's just sidestepped entirely.
That is massive. But what does the investor actually get out of this then, if it's a charitable trust? They can't just take the money back out, can they?
No, but what they do get is an income stream from the trust for the rest of their life or for a set number of years. It's paid out over time, and only that distribution is taxed, usually as ordinary income, which can be at a much lower effective rate than the huge capital gains hit they originally faced.
And what happens at the end?
At the end of the term, the remainder, the charitable remainder, goes to a charity that you designated. So you've transformed a crippling tax liability into an immediate tax deduction, a lifetime income stream for yourself, and a major charitable legacy.
That is the absolute textbook definition of optimization. Okay, what's the second strategy? This is one we hear about with tech founders a lot. It's called buy, borrow, die.
This strategy relies on one fundamental tax principle that is still, for now, sacrosanct. If you don't sell, you don't trigger a taxable event. The capital gains can be perpetually deferred.
But that doesn't solve the liquidity problem. I might have $100 million in Bitcoin, but I need $5 million in cash to buy a house or fund a new business.
Right. So you borrow against the asset's value. You use your highly appreciated crypto as collateral, either with a traditional lender or even through DeFi, and you take out a massive loan. The key is that loans are universally considered debt, not income. Therefore, they are not taxable events.
So I get $5 million in cash in my bank account, completely tax-free, without triggering a single penny of capital gains liability. And all the while, my underlying crypto is hopefully continuing to appreciate tax-free, covering the interest on the loan.
Exactly. You fund your entire lifestyle, you pay for major expenses, you reinvest, all using borrowed funds. And the capital gains liability on your underlying crypto just keeps compounding, deferred indefinitely.
And then there's the final, slightly morbid step in the name, the die component. This leverages something called the stepped-up basis.
This is a crucial detail. When the investor eventually passes away, the basis, which is the original purchase price used for tax calculations, is stepped up to the fair market value of the asset on the date of their death.
So what does that mean for the heirs?
It's the magic trick. If you bought Bitcoin for $20,000 and it's worth $500,000 when you pass away, your heirs inherit it with a brand new cost basis of $500,000. If they sell it the next day, their capital gain is zero. They have zero capital gains tax liability.
Wow. So you avoid capital gains tax your entire life by borrowing against the asset, and then your heirs avoid it entirely upon inheritance because of the stepped-up basis. It's generational wealth transfer, perfectly optimized within the tax code.
And then, for the really serious whales, the people managing portfolios in the 8 or 9-figure range, there's the ultimate strategy: relocation. If the domestic tax and regulatory environment becomes too hostile, you opt out of the jurisdiction entirely.
This is the legal nuclear option. We mentioned Act 60 in Puerto Rico before.
Yes, Act 60, specifically what's called the Individual Investor Act, offers these incredible tax benefits to people who become bona fide residents of the island. And, critically for a crypto investor, it offers a path to zero capital gains tax on any assets that appreciated after you established residency.
So if your portfolio is just that large, if the annual tax savings are more than the massive logistical cost and lifestyle change, it's a path to just legally avoid the entire U.S. tax framework on capital gains.
It is.
The crucial summary of this whole playbook, then, is this. The days of the Wild West being defended by a simple piece of hardware are definitively over. The most important tool for wealth defense is no longer cryptography or the hope of anonymity.
It's a highly skilled, very proactive tax attorney who understands these complex trust and lending structures inside and out. Compliance and sophisticated structuring are now the only viable defenses.
Which brings us right back, full circle, to our central theme. And it's a challenge to that initial philosophy of crypto freedom.
The irony is just. It's so profound, and it's a realization the market has to have. That core feature of the blockchain that created all the trust, the public, permanent, transparent ledger.
Its utility is fundamentally shifted. Instead of being this decentralized bastion against government control,
It has become the ultimate surveillance tool for a modern state.
it's the perfect digital panopticon. Every movement, every fraction of a coin, every association you make is recorded forever. And the IRS now has the AI to read it. They have the initial data from the KYC exchanges, and they have the legal framework closing in with things like the wash sale rule and the threat of an unrealized gains tax.
They never had to break the code. They just had to build the software to read the public book you were willingly writing in. They're just following the digital footprints you already left for them.
So the conclusion for any large-scale investor feels unavoidable. The Wild West is over for good. You can be traced, you can be taxed on money you haven't even realized, and your ability to minimize those taxes through active trading has been severely, severely curtailed.
The focus must now be on defense, and defense through legal means.
This has been a really deep dive, a true forensic investigation into the three major traps facing every digital asset investor today. We uncovered the frankly frightening capabilities of Chainalysis and Operation Hidden Treasure, proving that forensic tracing works and that through clustering and behavioral analysis, the IRS essentially knows your keys.
We then analyzed the severe financial threat of the proposed unrealized gains tax, detailing how it forces liquidation, undermines the very principle of taxing realized income, and exposes you to enormous volatility risk.
And finally, we discussed the closing of that superpower loophole, the wash sale rule, which is a major, major blow to active traders and their ability to offset gains, ensuring crypto is treated just as stringently as any traditional security.
The smart strategy is clear now. You have to pivot from a failed strategy of anonymity to sophisticated legal structures, like the CRUT or the buy, borrow, die strategy.
But let's leave you, our listener, with the core ethical dilemma that sits right at the center of this whole tax trap. It's something for you to think about long after this deep dive ends, and it builds on our discussion from part 2.
We spent a lot of time detailing the inherent unfairness of taxing unrealized gains, taxing paper profits, taxing value that isn't liquid yet because of the forced sale it creates.
So here's the provocative thought we want to leave you with. If the government successfully argues that the appreciation of your volatile non-liquid portfolio is real enough for them to tax at 45% before you ever decide to sell,
then shouldn't they also be obligated to provide you with a full immediate tax deduction or even a refund for your unrealized losses if that same portfolio drops dramatically before you sell?
the system is structurally designed for one-way participation. The government mandates full partnership in the upside volatility through immediate taxation, while leaving you, the investor, to shoulder 100% of the risk of the downside volatility, offering no reciprocal relief at all.
And that fundamental imbalance, that one-way street, Perhaps that is the ultimate and most profound unfairness of the crypto tax trap.
An important thought to consider as you navigate this new, highly scrutinized and highly regulated landscape. Thank you for joining us on this deep dive into the complex intersection of finance, technology, and government power. We hope you feel thoroughly informed and maybe, just maybe, constructively paranoid.